Hello, hello, Remote Work Europe people. It's good to be live with you again. And we've got an excellent webinar coming up for you this afternoon. I'm looking forward to introducing Elliott, who is from Abroaden. And as you know, here at Remote Work Europe, we prefer to try and empower people to do things for themselves. There are any number of professionals in Spain who will run this service for you or administer the other for you. That's great, and we do often need to use those services. But wherever possible, we really very much prefer it if people can learn to fish for themselves, to do things for themselves, and just get empowered by that knowledge to make the right sustainable decisions. So I'm going to hand over to Elliott now to take this away. He's got some great information to share with you. He'll be able to take questions from you as we go along, and there is the slides. Elliott, I'll let you introduce yourself in greater detail. Take it away.
Perfect. Well, Maya, first, thank you so much for the invitation. It's always a pleasure to chat with you. We've chatted before in the past. Had the pleasure to share the stage at one point, and we were just chatting before. So it's always a good time, and I appreciate the invite a lot. I love this introduction. You're talking about helping people do things themselves, because a lot of times it's just a matter of not having the confidence or the right information, but having the ability to do something. And when you can learn how to do something, or you get some support that you need, that little boost, then you can reach your goals or achieve whatever you set out to. And well, what I do at Abroaden is exactly that. We help people living and working abroad understand money better, how to build their wealth, how finances work, how money works, not only in the high level theory, because after all, I haven't yet found a culture that teaches financial education from early ages. And I come from the United States, which is, the country people think of when it comes to retail wealth and financial education. But not only that, we also help people understand when they're living in a foreign country, how the local systems work. Because I'm based in Barcelona, and I've lived here 9 years. There's still things that confuse me when I go to do administrative work, and I'm sure I'm not alone, especially in the fact that I have all of this background in trading and information on it. So today I wanted to talk a little bit about what people living in Spain and working remotely or working as freelancers, autonomous, can do to make better financial decisions, not have to stress about money, and really get the most out of their finances so that they can hit their goals just like anyone else. And then we're going to cover a few different points. So we're going to talk first about how to get the right money mindset so we can make better decisions and get our minds in the right place to take the next steps forward. Go over some good tips on budgeting, bank accounts, and how to keep things simple. Setting your goals and building a personal finance framework, which is super important if you want to turn your own actions into a wealth building machine. Pensions and retirement planning in Spain. This is one of my favorite ones because not even the Spanish know how this works. If I wasn't such a guiri, I could probably go and teach it to them. But since I'm part of the international, exactly. But since I'm part of the international community, I figured I'd help participate in our vibrant ecosystem and share my knowledge on how these works and some strategic tips for freelancers to manage money better. Finally, we'll get to a little Q&A towards the end. You've already sent me a few questions that we can dive into, and then we'll go over a couple offers we have for you today. Just to tell you a little bit about myself, I've lived abroad for over 20 years. I'll hit 23 years in August. Originally from the United States, if the accent hasn't given that away. I moved to Belgium in 2002 to go to university, where I studied business and economics. After a brief year teaching English to little children, I wound up working in financial services, started off in a bank, then worked my way out of that into fintech, financial technologies, which is also one of the main reasons I moved to Barcelona. If any of you come from Northern Europe, you also know the reason why we're here in Spain is mainly for the weather and the sunshine that we get. That was a big motivator for myself as well, but it was just also a really interesting step in my career journey. Since working in a financial technology company here in Barcelona, I've worked as a consultant, as a freelancer on the fintech marketing side for very technical content. And I started my own fintech itself, which is Abroaden. In addition to that, I co-founded BC in Fintech, which is the largest financial technology community here in Barcelona, where we have over 7,000 members. As you might have guessed, I'm a bit of a one-trick pony when it comes to fintech and financial services. I also hold qualifications in international wealth and investment management from the Chartered Institute of Securities Investment, which is the main qualifying body in the UK and that still operates here within the EU. So again, I should probably find a hobby outside of financial services, but it just keeps drawing me back in.
You got to have a niche.
Right. That's right. Find what works for you and go with it. Right. So first, I want to talk a little bit about getting the right money mindset, and this is super important before we make any sorts of financial decisions, because money has this really weird paradox, right? When it's just money in general, it's cold, hard numbers. If we're talking about reading a company's financial statements, if we're just seeing figures on the news, it's just a number to us. It doesn't really click. However, when we start talking about our own money, it changes and becomes not this number, but this emotional reaction to us. It becomes very personal because it's our money. It's how we interact with it. And it's very strange because ultimately all money is just a very convenient way to put a value on something. It makes it very easy for us to value goods, value services, makes transactions. But when it's ours, it has this different relationship with us. And that relationship really dictates how we approach any financial decision we make. So my first recommendation, whenever we're starting out to make a financial decision, start doing some planning, or even opening up our bank accounts, and we get that little feeling in our chest before punching in that code or pressing our thumb on the button to open up the account, is to take a few deep breaths. Just simple breathe in, breathe out. Maybe take 3, 5, whatever's good for you. The reason why we do this is it allows us to give ourselves that mental and emotional space so we can start separating, or at least acknowledging, that we're going to have a bit of an emotional reaction whenever we start writing down numbers or start looking at our bank account or investment account balances. It just lets us maybe not fully separate it and become machines, but at least gives us this very good breathing room, like literally, to understand and to make a more reasonable or informed decision. What's fascinating about the human mind is, we're animals, and 90% of our brain power we share with every other species in our group, in our kingdom. But there's this little part, up the front of the mind that separates us from these animals. And that's the one that can both make us be incredibly smart and also incredibly impulsive. So we really want to make sure we're controlling that. A few deep breaths goes a really long way on that front. Next, and this is something really important, not only for freelancers, but everyone in general. However, freelancers are most impacted by it. And it's something called the feast and famine mindset. I'm not sure if you've heard of this, but if you've worked as a freelancer, and especially when you're not working for just one dedicated client, I'm sure you've experienced this. So the feast and famine mindset is this common pattern that we see for people working as freelancers, or who are maybe they're working as employees and they're maybe doing sales and they get a lot of their income from commissions. And it more or less goes like this. When times are good, when you got a lot of clients or you got a lot of good paying work, like, hey, this is amazing. I got all this money. I have all these wonderful income coming in. Things are going fantastic. And yet, as we know, whenever we've done freelance work, the good times don't always continue. There can be lean months. There could be things outside of your control. A client decides that, well, that project was good for now, but it was really just limited in that scope. Or there could be some sort of economic condition going on where a new world leader decides to throw gasoline on the world's economy and everyone has to pause for a second. Not that we don't have a recent example of that. But in that case, everything kind of slows down. And all of a sudden, this cash flow that we almost got used to, this lifestyle that we built around it, disappears. And that's where we go into this famine mode, where we're like, all of a sudden I have to radically adapt my life. I start doubting myself. I start thinking, well, hey, am I really that good? Why don't I have more work? And all these things, all of these liabilities maybe we've created by creating a lifestyle that's a little bit too rich for our budget starts creeping in. And we just start thinking negative thoughts. And it's really bad for us because it becomes this negative cycle. You can't plan ahead with confidence because you have no idea what's going forward. You start doubting yourself. You're always reacting to situations instead of being proactive. You're thinking, I have to survive. You go into survival mode instead of being proactive and being strategic about it. Because again, our mental mindset goes from thinking about numbers and strategic decisions to this emotional state that we really try to fix with breaths, right? Well, here, if we're not careful, we can't break this cycle. We're going to get stuck into this doom loop. It can lead to places where you're making really bad decisions, like you're undercharging clients to try to get some cash flow going, or you're even getting to the point where you're burning out, or you're having this emotional game, your health takes a dive. It's not a good spot to be. And again, as I mentioned before, it's really not just for freelancers. Employees can also fall prey into this trap. Pretty much anyone who works in the private sector is going to feel it. So if you're a remote worker working for a company in another country, but based here either as an autonomo or on an employer of record contract, you can also fall into this trap too, especially if you're making money in a foreign currency. And we'll touch on that a little bit later on in this discussion. And really, the best ways that you can get out of this is you want to make a goal-driven and well-defined financial plan, not only when times are bad, but when times are good. And that's really about basic financial discipline. You want to ensure that you're not just indulging in all this new money during the feast cycle, side of the cycle, where it's like, oh yeah, the good times are just going to keep on rolling on, and I'm not going to have to think about anything else. And all of a sudden, you've inflated your budgets and your expenditures, and it gets to a place where it's not sustainable. It's really important to define what your lifestyle would look like, what it would look like when you have that extra cash, and just consider it as a bonus rather than the new norm. Crucially, the most important thing that you can do during moments of momentum is leverage that to grow your business to the next sustainable level. And what that means is, like, while you're taking on work, while you're taking on clients, really try to figure out how you can leverage the great work that you're doing, the good feedback that you're getting from your customers, and take that to market and grow your business. So in case one of your business lines drops out, you have others that you could leverage, or even you've grown to a point where you're lucky enough to transform from being just a solo entrepreneur into taking a team or to contracting out some support staff and really developing it out to this next level. So you can get to a place where, hey, maybe your baseline famine level is what your feast level was before. And again, this takes a lot of patience and discipline just to think about this when times are good. And especially when times are good, you're super busy. However, budgeting the time to take care of that could really help save you thousands, if not tens of thousands of euros in the long run. So it's really crucial to budget time to understand this, to recognize the cycle, take a couple of deep breaths beforehand, and try to break it, or at least recognize how you can ride that cycle safely and without losing your sanity. Next, I want to talk a little bit about budgets, bank accounts, and keeping things simple. This is going to come out as a little bit counterintuitive, especially since, you think I have one bank account, I only have to check one place to get information about my finances or to manage my money. But actually, if you're a freelancer, or even if you're just an individual, multiple bank accounts will keep things simple if you're strategic about it. And really why this is so important is for a couple of reasons. First, in general, regardless of what you do for your income, you're always going to want to separate out your spending money from your savings and investing money. The best way to do that is to not keep all of your money in your spending account, because otherwise you could have a moment of pure joy or pure impulsiveness and go out and overspend the money that you have, and not having that money on the account would effectively block that payment, assuming there's no credit line linked to it. But more importantly, you're able to keep it separated and to be able to use it for your budgeting goals. Now, if you're a freelancer, as an autonomo, you're going to want to make sure that you're also separating this out, because you want to ensure that you're not mixing business with personal. And if you're an autonomo here in Spain, or freelancer here in Spain, you know firsthand how complicated it can get every quarter. And it's that time of the year right now where we have to do our taxes. I have to do my taxes tomorrow for the company. And it's always important to keep that separated, just so you can have peace of mind and you're not going to run into any issues where there's a debit taken out of your account and you don't have the funding in it, and you have to deal with either paying overdraft fee, or you have to go in and manually transfer money, and you have your accountant, or worse, the Social Security people or the tax authorities, the Hacienda, asking you, hey, we tried to take money from you, but you didn't have it. Now we're going to have to chase you for it. So that's really crucial why it's important to have these different accounts set up for yourself, really one that's going to have an account for your business activity and one that's an account for your day-to-day budgets. So the other reason you want to look at this is that you want to be a little bit smarter about how this works for you. Mainly, you can look at a couple different strategies if you're a freelancer to be smart about your withholding strategy. And again, why this is important to look at is if you've separated your cash from the money that you're spending and the money that you're generating from your business activities, is you can be a little bit strategic with how you're managing your money vis-a-vis the government. So there's really two ways to look at this. First, you borrow money from the government where you underpay your taxes And at the end of the year, you're going to fix the difference, right? Because the government here, the way it works out is you kind of estimate how much you're going to pay them, and then you set an amount. And at the end of the year, well, when you start doing the annual declaration, you're going to find out whether you were right or wrong. And there's two ways you could approach this. The first is you could either borrow money from the government in the sense that you underpaid your taxes and you put all these funds into a high yield savings account. And from there, what you're going to be able to do is that money that you might owe the government, you're going to be able to earn some interest on it over the year. At tax time, or right before you file your taxes, you take that money out with the interest earned and you put it into the account that the government's going to deduct the tax bill from. Now, this is quite useful because you've paid your tax bill, but you've also earned some interest on the side. This is the corporate treasury management 101. Only risk here is that if you've completely miscalculated or you're not getting the return you expect, or if you put the money into your own bank account and you've accidentally spent it, you might have a nasty surprise where you're going to have to dip into your own personal savings on your own personal side of the account and get it back. The other side of this is you could lend money to the government, which is effectively the opposite strategy, where you overpay money each quarter to the government when you're doing your tax declaration, or if you're an employee, you can ask your HR person to increase the amount of tax that you're paying. And then after you do your annual declaration, you're going to receive some money back. This strategy is interesting if you want to avoid a nasty surprise. However, the big issue with this one is that when inflation goes up, like we saw the past few years, the government will not pay you any interest on the loan that you're giving it to them for paying them a little bit extra tax. So the problem with this strategy is effectively you're giving an interest-free loan to the government, and you're not getting any of that in return.
You might not get that for months and months, right? We all know
exactly.
that they're not paying it back in a rush in July, are they?
No. And in a lot of cases, when you have your own company, it will be more like December when you get it. So think like if you've withheld in, from quarter one of this year, well, it's going to be towards the end of the year next year when you might receive that. And that could be a sizable amount of money you lose. However, you also don't run into the risk that there's a nasty surprise. So this is, again, why it's so important to be strategic about this and make sure you're separating out your accounts that can really work for you. Once you have your account set up, you really want to set up a budget. And budgeting is one of these things where it can get kind of personal and can seem kind of annoying. But honestly, if we take our time to figure out a budget and get one that works for us, it will save us a lot of stress in the long run. There's a couple different budgeting methods that you can use if you're struggling to figure out one that can work or to implement it. I'm going to go over 3 of my most favorite ones that I like to use, but there are tons more out there. And really the goal is to find one that works for you. It doesn't have to, you don't have to adapt yourself to a system you're not comfortable with. Rather, the budget adapts to the way that you're comfortable operating and doing your day-to-day life. The first one I like is the 50-30-20 budget. 50-30-20 says that you pretty much take out your monthly income, your net income, so after taxes, after you've put your money from your business account into your personal account, and then put 50% of that just for your living expenses. So this is going to be things like your rent or mortgage payment, your utilities, your basic food. So when you go to the grocery store, basic clothing, just things you need to live your life, to survive, for lack of a better word. The next 30% is for fun. You've earned this money. You deserve to treat yourself to whatever activity within your budget that you can do to enjoy the fruits of your efforts and your labor. The next 20% is for your savings and investing goal. That pretty much means whatever you define that as your goal, you're going to be taking that money and you're going to be saving it, or ideally investing it towards your short, medium, or long-term financial goals. What's also cool about 50-30-20 is, let's say that you have like a big short-term savings goal that you want to hit. Well, you can just switch the 30 and 20% inputs and say, well, I'm going to save and invest 30% of my income and have fun with the remaining 20%, cut down on going out to eat or going out for drinks or whatever it is you want to do for fun. And that way you can just quickly adapt and give yourself that boost you need to hit maybe a short-term goal like saving for a bigger vacation or putting a down payment on something. Again, just protecting that 50% for your living expenses. Next one is the 80-20, which is just a simplification of the 50-30-20. And the 80% is pretty much all your living cost and your fun just lumped together. You don't have to sit there and budget it out in a spreadsheet or looking on, maybe your bank has an app that will tell you your spending breakdown, and then the remaining 20% for your savings and investing. Super simple. All you literally have to do is say each month, let's say I make 2,000 euros a month net, I'm going to put 400 euros into my savings and investment account. It's done. Everything is on its way, automatically transferred. You don't have to think about anything. Last one you can look at, and this is for the detailed-oriented people, is zero-based budgeting. And zero-based budgeting effectively means there's no euro or no dollar base behind. And what you're ultimately going to do is you're going to assign each euro that you're earning to a specific cost. So if my rent is, I don't know, 900 a month, 900 of my euros is going to go to my rent, and I have 150 euros in total utility bills. 150 is going to go to that. I'm going to spend 260 euros on food. However it goes until you hit your budget, you know that each euro is accounted for. This is actually quite useful to do maybe once or twice as a benchmark to understand where exactly your money's going, not so much as a proactive exercise, but more of a reflective one where you can go back and say, all right, well, this past month, this is how my spending broke down, and I want to say cut down on one vertical within my overall expenditures. Let's say I've been spending too much going out for ice cream, although it's really hot outside. And here in Barcelona, we have these great Italian ice cream places. But still, maybe you shouldn't be spending a couple $100 a month on ice cream. Not that I've done that before. And either way, you can go through and look at these. Yeah. Anyways, it's a good way to understand how your budgeting is set up. And if you're really one of these people that wants to have everything neatly organized like that, you can easily implement this because you're probably already wired to think this way. Anyways, next I want to talk a little bit about setting our goals and building a personal finance framework. And really, before we get to that, it was really important that we covered budgeting and setting up our bank accounts to operate properly, because that is really the prerequisite to building out this framework that's going to help us hit our goals and help us reach whatever financial dreams and aspirations we have. First, what you're really going to want to do when you're setting out any sort of financial plan is to make sure it's very structured. It needs to be smart. The reason why this is so important is because if we're not defining what our goals are concretely, it's impossible to reach them. I remember the other day I was having a coffee with a friend, and she was asking me about my business. I'm like, yeah, well, this is what I do. Earlier in the week, I had taken a training because I have my qualifications. I have to take a training every month. And I took this really interesting one on a certain financial planning method. And she remarked, oh, well, financial planning is only for people who want to get rich. And I thought, well, that's an interesting point, but that's not correct, because what does rich mean, right? Rich for me means something different than it means for you, Maya, or it means for anyone else who's on this call. Or we could survey 1,000 people, and rich has this very individual meaning. And that's why it's so important that we define our goals and we come up with a smart plan to do that. The reason why I'm calling this smart is there's this wonderful technique called the SMART planning method. I think if you've ever done any sort of project management or IT development, or even just anything structured around planning, you might have heard of it. And SMART is this 5-step process where you're going to look at any sort of financial goal or any goal in general, and you're going to measure it from 5 or quantify it against 5 different metrics. So first you have S for specific. So it has to be a specific goal. As I was mentioning earlier, you talk about financial plans. If you say, I want to get rich, well, what does that mean? Be specific. Is it something like, I want to have, when I hit my retirement, enough money to cover my rent and to go traveling once a quarter and to go out to eat once a week, and I estimate that's going to cost me X amount of money. Well, X amount of money is going to be my goal, and that's going to be a specific one that I've set. Measurable means you're going to be able to measure whether or not you're successful. You're going to be able to go back, and this is where you think like a scientist and say, if I do this, then I should be able to hit that if I'm right. If not, I have done something wrong, and they can go back and reevaluate it. Achievable for A means that you can achieve it. It's going to be within your realm. If I say I want to have $1 billion by this time next year, that's cool. I know how to measure that. I'll know if I'm right or wrong. I don't know how I would have the capacity to make that money without taking an enormous amount of risk and spending a lot of money that I frankly don't have to make that happen. But saying something like, well, I want to have, €1.5 million in my retirement account by the time I hit retirement. Well, maybe that is realistic. And actually for a lot of people, that is an achievable goal. Realistic means, again, it goes down the same way. It's like, am I going to be able to hit this goal in any meaningful way? Is it going to be something that I can do within my limits? Is it something that I can do with the resources I have? Or if I need external resources, what are they? Is it going to be able to help me to make them? Is it something that's not going to sap all of my time? And then speaking of time, we also need to have a time-based metric on there to see how long it's going to take us to reach our goals. So if we talk about retirement, maybe that's 30 years, 25 years down the road, but you always want to be able to measure that because it's going to help you match out all of the criteria you have above and find the right financial services providers and financial products and whatever you need to have in place to reach that goal or to get yourself closer to that goal than you would have before you started that exercise. Once you've set out a SMART plan, or any plan really, you don't have to follow the SMART method, but you really just need to make sure that you quantify what you want to achieve. You're going to set up a financial and a money blueprint. First thing you want to do is you want to make sure you have a safety net. We've all been taught this. You need to keep money away in a rainy day fund for when times might be bad or for unexpected costs. This is an amazing advice. It's personal finance 101. And if you don't have one already, it would be the first thing you'd want to set up, the first thing you'd want to plan for. Your emergency fund is going to be 3 to 6 months of basic living expenses. So if we go back to the 50-30-20 budget, it would be that 50% that you'd want to cover, plus maybe 10% on the fun side, 5% on the fun side. Because again, just because times are tough doesn't mean that you should completely torture yourself. You deserve to treat yourself to small little treats that will give you this mental and emotional break that will make getting through a hard time, because ostensibly if you're pulling from your safety net, something's not going as smoothly in your life as you'd like, and to give you that mental resource. Maybe not go out and spend a couple $100 on ice cream, but once or twice a week, go out and get that ice cream cone from the Italian place down the street. Whatever it is that makes you a little bit happy, but that's going to be in your living expenses as part of that 50% plus maybe 5 to 10 to keep yourself sane. If you're a freelancer, especially if you're one with multiple clients, you're going to want to aim to keep it a little bit bigger in terms of your buffer. Go closer towards 6 months. And this is really to avoid a bad famine. As we talked about feast and famine earlier, you want to make sure that you have enough to really ride that out, smooth things over, give yourselves the resources to not only take care of yourself mentally and physically and to have your basic costs covered, but to give you that buffer to go out and find your next clients, to be able to cover what it's going to take you to do that business development, which is, as you all know, is way easier said than done. In terms of where you want to put it, you're going to want to keep it in a boring savings account that you can access instantly. We've had some questions coming through before the talk about different types of savings accounts. How do you get the most interest? How do you get the most return? We'll touch on that in the Q&A, but generally this wants to be in a place where it might not be paying a lot of interest, but you can touch that money pretty much whenever you need it. So generally, if you have the possibility at your current bank where you have your spending money in, you'd want to create a savings account with them on their books that can transfer pretty much 24/7. As long as their system's running, you'll be able to move money from one account to another. Next, we take a look at sort of your short-term goals. So once we've got our safety net set up, we're going to want to take a look at these short-term goals and excess cash. And these are for life's little luxuries. So whenever you have a little bit of extra cash outside of your safety net, and it's either for something like saving up for vacation or something, like a purchase you've had on your mind, and hey, you've worked hard for the money, you want to put it there. Or if you have some limited extra cash where you don't know exactly what to do with it, but you're going to budget out the time to figure out where you want to put it for a more long-term goal. You can keep this in a higher yield savings account, mainly because you don't have to touch it right away and you can benefit from higher interest rates. Next, we're going to talk a little bit about long-term goals, because these are crucial for building your future wealth. And we're talking about taking some investment risk, taking the ability to really let time and compound interest do its magic. And the objective here is to take as much risk as you're comfortable with for the highest return. And the key word is comfortable with, because you don't want to take too much risk where you're losing sleep over your investment or financial decisions. Crucially, you want to avoid savings accounts. These things are really not made for long-term wealth growing. You lose more money in them once inflation kicks in than you get return. And also, if you're being mindful, you need to be mindful that if you're planning on leaving Spain soon, you need to choose the right sorts of investments that can cross borders with you whenever you go. And we'll talk about that here in just a little bit. Last, I want to talk a little bit about medium-term plans, because this is kind of this weird, mushy middle space between short-term goals and long-term ones. And these are goals that could be things like a home purchase, maybe going out and doing a master's or doing some professional training, if you want to take a career break or sabbatical. And they're often tricky to plan for because there's not really any good investments for them, at least not easily ones to find, because you're really trying to balance getting the most return. Because these are going to be in the shorter term, you want to have a more certain return or more certainty over what that money is going to be like. So it's really difficult to plan for. I've talked about this before in other workshops I've done. I'd love to, if you're interested, be happy to invite you to another one that I do. But really, this is a very difficult one to plan for, and that's why I kind of put it last. Next, I want to talk a little bit about pensions and retirement planning here in Spain, going back onto that long-term investing goal, and really your future security. And this is a fun one, a fascinating one, just because nobody understands it. And I did this course on pension plans in Spain, and it's absolutely fascinating because Spain has a pretty interesting system, just nobody knows about it. So first, Spain, like most countries, has different pillars, and the pillars really go down to different levels of and different types of pensions and investment accounts. The first pillar, and this is like this anywhere in the world, is some form of state social security, aka a public pension. This is the foundation of the state public pension system here in Spain. Everyone is paying into it. Assuming you're doing your legal duty and paying into Social Security, or you have it set up where it's all compliant. If you're paying into Social Security, either as an autonomous or as an employee, you're paying into this system because you have no other choice, effectively. What you're actually doing, instead of putting money with the Spanish government and they invest it for you now so you can have it when you're retired, is you're pretty much lending it to people, to the Spanish government. They're paying current retirees and they're giving you credits that you're earning. There's probably not enough time to go into it, but since Spain is Spain, it goes down into the system where you have to earn credits first in years and then in months, and it gets really wonky towards the end. In short, if you've worked here about 15 years, you're entitled to a half pension, and then per month it generates at one level, and then when you get closer to retirement, it goes faster. But yeah, the idea is that when you get to retirement, you've earned X amount of credits and you get Y amount of money from the government, assuming it's there. And of course, that's another question for another day. Retirement age in Spain is currently 67 years, or rather 38 years and I think 8 months of work. That's for right now. Unless you're very close to that age, it's almost certainly going to go up. Other thing is, if you move countries periodically, you can likely transfer your credits or get recognition for the credits you've paid into. Here in the EU and the UK still participates in this system. If you've worked in Spain for, 8 years and you move to, the Netherlands will say, all right, well, you've earned these X amount of credits, so we'll just recognize that you've paid into the system. And then eventually, if you retire in the Netherlands, you get part of your pension paid from the Spanish government and then the rest paid by the Dutch government. And they tend to recognize each other. If you go outside of the EU or the UK, it will really depend on the Social Security agreement between Spain and the other country. Spain and the US just revised theirs, so they both recognize each other's credits fully. But in general, you don't really have to worry about this in terms of portability. You just have to worry whether or not the money will be there when you hit retirement age. Before touching the other the other pillars, I want to mention briefly the 1,500 euro annual pension credit that you have in Spain. So each year you have 1,500 euros that you can invest in the second and third pillar, and you can take that amount that you've invested and deduct it from your gross taxable income amount. So let's say if your gross taxable income before the credit is 40,000 euros, well, if you've invested into one of these plans up to the maximum, then you would only be taxed on 38,500 euros. Not bad. Second pillars here in Spain are what we call the employment-based pensions or occupational pension plans. They're really linked to your employment, or if you're an autonomo, there's an autonomo version that you can participate in. Here in Spain, employees can contribute up to the 1,500 euro credit, and then their employers can overmatch up to 8,500 euros per year, giving you 10,000 euros into your pension account. If you have an employer that does that, that's amazing, because the problem is most employers not only don't participate in it, but those who do will never or almost never match that high into the program. If it exists, it's an amazing deal. However, it's very rare. There's only a few industries that are companies and industries that are participating in it. So don't push your luck on that one. Instead, you're going to have to rely on other pillars. If you're an autonomo, though, you actually do have some pretty cool options. Back in 2023, the Spanish government changed the rules on pensions, and they gave the autonomos a very rare break for once. And autonomos can contribute up to 5,750 euros per year, and that includes the 1,500 euro credit into a qualified autonomo or freelancer pension plan. And this is quite cool because not only can you get a pretty decent tax deduction, but there's some interesting plans out there. And I have a guide you'll be able to download at the end that has some links to some of the better providers here in Spain. But some of these providers, they have low fees and they offer pretty high returns for what they are in terms of pension plans. So that's something worth keeping in mind if you're an autonomo and you're going to be here a long time. Why I say a long time is because there's a 10-year lock-in period with these plans, meaning that if you invest 1,500 euros today into a plan, you wouldn't be able to touch that 1,500 euros until July 2035. And that keeps on going and going until you get closer to retirement age. So what's important here is if you leave the country, because these aren't portable, is you're going to be stuck with a pension plan that you're not going to be able to continue to contribute to because another country is not going to recognize Spain's domestic tax system. And because it's not very portable, well, it's just going to sit here. And yes, you'll get some money at the end, but maybe, it might not be the best overall return in the long run. The third pillar are elective pensions and savings products and not employment linked. So really you have to choose the plan. These are the ones that are most commonly sold by banks. There's plenty to choose from. There's ones that deal with investment products where they're just investing in investment funds. There's insurance-linked ones that have certain benefits related to insurance. Mainly, you can pass those on to your heirs when you decide to, when you transition to the other world or whatever happens at the end. And you can really apply the credit versus contributions. There's a 10-year lock-in period with these. There's some other short-term savings accounts like SILAPs and Oro Cincos, which is pretty much like insurance-linked savings plans for 5 years, but you can apply the credit to it. But really what you want to be careful with here are the high fees and the low performance on them, just because pension plans in general are supposed to be conservative, and most vendors of these are the banks and the insurance companies, and they make a lot of money on the fees. So you really want to keep an eye on A, how much is the return, and B, and this is even more important, is the fees, because the fees are going to subtract from the net performance, and you have to subtract the rate of inflation, and that will give you your real return. And on many of them, you're not getting even 1%. So that's something you really, really need to be mindful of. Last, you have the fourth pillar, which is your do-it-yourself investments. These are investments you make and manage yourself. Anything you could think of, whether it's investing in real estate, investing into investment funds, stocks, bonds, alternative investments like crowd lending, crowdfunding, commodities, crypto, whatever it is, you do it yourself. Issue is in Spain, there's almost zero tax benefits for doing so. You cannot apply the 1,500 euros a year, and any sort of capital gain you make or any sort of income you get, with one small exception, you're going to have to pay that on your tax bill. As I was saying, there's a ton of different investments you can choose, and what's really nice about a lot of them is they can cross borders easily, especially if you pick ones that are registered internationally or are accepted by brokers and other intermediaries worldwide. Real estate, obviously, I guess you could pack up a house brick by brick and drive it across a border. Generally, people don't do that, especially since the land is really what's valuable there. But the tax treaties are very clear. Like if you own real estate in another country and you get income there, there's ways you can deal with that. So again, this is a very interesting one, and it's super important because with this pillar, we own our own destiny. We're in charge. We're not dealing with a bank or an intermediary or a pension fund provider to make decisions for us. We make the decisions. We have full control over it, and it's the highest chance for the best returns. And if we're not planning on staying in Spain over the long run, this is even more important, because these little pension plans that seem nice, if you're staying here for the long time, well, it creates a liability once you leave. So this is what everyone should be focusing on, not just individuals living and working abroad, not just people who might leave after a while, but everyone, the Spanish included, people in their home countries, they all need to be thinking about this, and it's crucial we do this. And it's hard for us because we have to do it ourselves, but once you know how to do it, it's quite straightforward, very easy to do, and it's really worth focusing your effort on. So again, here it's really a matter of seeking cross-border friendly investments. Diversification is crucial, and as I mentioned earlier, Spanish mutual funds get a little bit of a special tax deferral, but with some cases, like I said, I talk about this in my pension plan course we have in far greater detail. So if you're a freelancer or remote worker here in Spain, there's a couple things that you can do to keep yourself a little bit sane or take advantage of a couple different programs to ensure that you're getting not only the most out of your money, but B, giving yourself a bit of peace of mind, financial well-being, whatever you want to call it. The ultimate goal is not to stress about money, but to let it go to work for you in ways that don't get in your way. First tip, and I'm sure you've heard this, but don't be an autonomo if you can avoid it. Spain does not like freelancers. There's just tons of things I'm not Spanish, and I try to be diplomatic, but this is just not it's not very beneficial to be an autonomo here. There's a few things that stick out. There's no limited liability protection. So I don't know if you know this, but if you screw up with a client and they sue you, they're going to go after your personal assets. You're not shielded from your business activity like a limited liability company would. There's disproportionate tax and administrative burden. The same quarterly filings that you have to do and going on to the Reta, which is the Social Security, you have to do that as a company too, but companies have lawyers and protection in a way that helps them out on this. Less Social Security protections than employees. I'm going to touch on this in a little bit, but there are some benefits you get. Like the best thing you'll get is contributions into the local pension plan, as well as access to the public healthcare system, but other benefits employees take for granted, we don't get as freelancers. And then they're very strict on business deductions. I've heard countless horror stories of someone just saying, I went out to dinner with a client, and the hacienda is like, no, you can't expense that because you're just cheating the system. Whereas if you do that under a limited company, they don't even bat an eye. So if you can avoid being an autonomo, you really want to try to do that. There are a couple different ways you can do this. If you're working remotely for a company and they ask you to become a freelancer here, really lobby them as hard as they can to hire you under a local employment contract via an employer of record company. Things like Deal, Remote, Oyster. And what these companies do is they'll hire you under a local contract. You become an employee of that employer of record entity. And then your employer, who you actually work for, just pays them your salary plus taxes and all these fees. And you don't have to worry about anything. You become an employee. Life's beautiful. You get all sorts of Social Security protection. You get paid days off, all that fun stuff. So if you're a remote worker, but your company's kind of nickel and diming you and putting all that burden on you, really try to negotiate with them on that. I would ask them for this sort of status over a pay raise if I could, just because it's so much easier for you. Depending on how much money you're making, you could also consider creating a Spanish limited company. This is really if you're making at least 60,000 euros a year or more. The benefit here is, well, A, you're not an autonomo anymore, at least in the sense that you're fully exposed. You have the liability protection. You will still have to be an autonomo as the director, but it's kind of baked in. You can pay yourself a salary, so you can become an employee of the company. And you can also get yourself a balance between dividends and salary payment. And again, here you're going to want to talk to an expert who will set this up for you. If you have a lot of Spanish companies, there we go. Yes, I was about to say, Maya has a whole lot of resources on this. So, but again, this is something really worth thinking about. I get this question quite a lot. I always refer to these partners. But again, that's one route of going in. You could create a foreign entity like in Estonia. And I know, Maya, you've done a ton of work with the Estonians on this. And
yeah, happy to talk about that. It's just it doesn't work for every kind of freelancer, depending on whether you're really working in Spain, then you're going to find that the Spanish want to treat that as a Spanish company anyway. So happy to talk to individuals about that or put you in touch with recommended suppliers.
Perfect. Yeah, perfect. And that's what I'd say about this is like these foreign entities can be tax efficient and way more administratively easier to deal with, but you have to be very careful on how you set it up. Seek expert advice. Don't just take one off the shelf, because otherwise the hacienda is going to start asking questions. And if they think you're a Spanish company, well, they're going to tax you as such, even if you're not really a Spanish company. Mm-hmm. But yeah, I'll leave that to some of the amazing resources Maya has on her side. Next thing you want to do is protect your income when you're sick. When you're an employee and you're sick, you go on Baja, right? You go to your public health office or health center, and they say, hey, I can't work for 3-4 days. They give you a note, you give it to your employer, and what happens is actually they stop paying your salary directly and Social Security pays it, and you really don't feel much of a difference. You'll see a slight drop depending on how long you're out, but it's most of your income. When you're an autonomo, You do have the right to go on Baja, and you do have a right to some money from the government, but it's nowhere close to what an employee is making. Generally, what you'll get is around 650 euros per month. There's a calculation based on your contributions and all this stuff that the Spanish government says. But the problem is not only is that very low, you don't get the payment until the next month. So if I'm sick today, I'm not going to see my payment until August. And you still need to make contributions to Social Security while you're sick. So it's very possible that you're not even making any money on that. You're effectively losing money, just losing less money. But there's a way that you can protect yourself here in Spain if you're an autonomo. And I think not enough people are doing this, but pretty much what you can do is go out and get supplemental Baja Laboral insurance. And this is meant explicitly for administrators of companies who are effectively autonomos themselves. And more or less what it will do is it's going to boost the amount of money that you're going to receive when you have your Baja. First, they're going to pay you out your claim within 24 to 48 hours. You're not going to have to wait a month to get your money. They have higher coverage. Some of the plans I've seen have gone up to 2,200 euros per month. And this is divided by working days in the calendar. And the best part about this, I'd say the second best thing about this, the first part being your budget when you get wrecked, is you can typically deduct up to 500 euros of your premiums from your taxes. So again, like with that pension credit, you can add that to your deduction and lower your tax bill from it. Some of the insurers, actually many of the insurers, will also bundle benefits with these plans. So if you've been thinking about getting maybe private health insurance as well, they'll do a deal where you can get their Baja Laboral as well as get on one of the private plans or some other services they have. So it's actually quite interesting for you, just if you want to protect your income. I highly recommend looking at those. I have links in the guide for it.
Do you have any sense of what the premiums are for something like that? Because it sounds, I've been winging it without it, and I have cause to regret that.
I've seen them start around €3 a month. Obviously, the payout's going to be a bit lower, but they're quite reasonable. A few hundred a year seems to be about the sweet spot there. It really depends on what you want from it and how much you're going to protect yourself on that front. So again, like the amount like that, 2,200, you're going to be paying a higher premium, but they do have varying plans. But it's far better than what you're going to get from Social Security alone. And yeah, so we talked about this earlier. The freelancer pension plans make a lot of sense if you're here for a while. Like if Spain's kind of your last stop before retirement, or you don't see yourself leaving anytime soon, I would highly suggest looking into one of these plans. It's a really good deal, especially if you pick one that has pretty good returns and low fees. Again, I have a list of some of the providers here that offer these tax qualified ones. Last, this is a hot topic lately. And I know many freelancers are working remotely or have customers all over the world where they're getting paid dollars, pounds, maybe Swiss francs, Canadian dollars, you name it. If not the euro, you very quickly start to understand foreign exchange markets and currency risks. I have a plan to run a webinar on currency risk in the coming days, but high level currencies are just a comparison between two economies and their performance. It's a binary decision. The cool thing about currency markets, you have two chances to be wrong on that front. They're the world's largest markets in terms of volumes. There's $7.5 trillion of trading volume per day going through them, an absolutely massive amount. But all that is to say, you have zero impact on it. You can do absolutely nothing to control it. You just have to accept it. And I know recently, especially if you've been making dollars this year, the dollar's lost 14% of its value versus the euro, which is stressful. I've earned dollars in the past. It's not a pleasant experience. There's a couple ways that you can manage this currency risk. Is you want to know what your baseline costs are euros. So if you're going to start taking out projects in foreign currency, you want to really know what those are, translate those into your cost into that currency and add a bit of a buffer to it. Get paid in euro whenever possible. Some customers haven't figured this one out. And if you can get that to them, you can invoice them in euro and they'll pay you in euro, go for it. By all means, go for it. And again, that goes down to invoicing in euro when possible, or having an agreement in place with your customer saying like, hey, well, we're going to have to do an adjustment if the exchange rate hits X amount of money. And that would be for the customer to implement a hedging strategy. I moved to Barcelona to work in a fintech focused on currency risk management. So I get really nerdy about this. But there's some really cool things you can do around this. Oh, cool. Again, finance nerd, cool for me has a very, very unique definition. The best exchange rate is the one you can get now. People sometimes say, I'm going to hesitate, wait to see what happens. No one can predict what the exchange rates are going to do in 5 minutes, let alone a few years from now or a few months from now. If you want to wait and you want to think, well, maybe there'll be a better one, you could, and you have a lot of money you want to exchange, you can always do it in transfer, do it in batches, making transfers periodically to average out the exchange rate. That way, over time, you could get an effectively lower rate. This kind of makes sense if you have a bigger purchase. Invoicing each month, that gets difficult. You could ask your customer to pay you up front and say, let's say you have a big project and you say, well, 50% upfront, make that payment in euro and maybe make the less payment in dollars or vice versa. That way you can all hedge out that risk a little bit on that front. You could ask them to deposit that money into a euro account already. So if they use something like TransferWise or one of the many other platforms as a business account, they can say, well, create a wallet or a bucket, a jar. I think that's what Wise calls it. And say, all right, we'll create a jar in euro for this, and they're going to get this interest in euro, and they're going to be able to deposit that money and pay you out. It's, again, about having this conversation. I'll touch on this on that workshop I'd like to run in the next couple of weeks. Again, I selfishly, I see the exchange rate get volatile. It means an opportunity for me to do content, but I totally understand the pain of many people.
Can I add one more bullet point to that, which is don't use a Spanish bank to exchange currencies.
100%.
Because you'll lose so much on both the rate and their fee. When we have access to options like Wise or Revolut, it's a no-brainer to open a separate and do it through there.
The only exception I make to that is if, let's say, you're buying property here and you're bringing in maybe 100,000, then the bank will give you a very good rate as part of a mortgage.
They still charge you to receive that funds, but you could use it right.
Add it on there. But in general, like unless you've negotiated it as part of some other deal, stay away. And there's actually really good brokers for large amounts of money too. I wouldn't use Wise for a large amount of money. There's some other ones for that. And yeah, set a safety rate in your budgeting. But yeah, that's pretty much that in a nutshell. I know we've covered a lot in this, but I would love to, since we have time, I think I hit this in 50 minutes with the intro. So
that's pretty good. So yeah, that's pretty tight. We've had some questions anonymously because finances are all,
of course,
sensitive subjects. So before we answer any of them, I'll just remind everybody that this is content, this is general information. We're not going to be able to deal with anybody's personal, individual financial planning or tax advice or anything else. If you need that, then you need to pay for Elliott's time directly and individually, and you will get that individualized advice which you can act upon. So we'll be putting up an offer for that at the end of the session. But we've had some questions in advance. We've also got a question going right back to the tax equation and that interesting way of looking at it right from the beginning.
Yes.
This might be one you want to say, refer to your gestor, but I think this is really important. A lot of people do just pay, so this is what you have to pay this quarter, and you don't even think about it and do it differently.
Exactly. So I talked to the gestor about the strategy there, and you'd want to work with the one who's willing to adapt to that. And again, as not all gestors are created equal, and there's some ones who are more, I don't want to say creative, but more flexible. There we go. Towards this thing. So that's one way you can do it over the long term. The other thing is, well, if you have quarterly payments, well, you can deposit that extra cash into a higher yield savings account over those 3 months and gain that daily interest. Again, interest rates have gone down over the past year and a half, but they're still going to be far better than leaving it in like your Sabadell account where you're getting 0.3% or something horrible. But as long as you're smart to say, well, I have this extra fund, I'll just sweep that money. Sweep is this financial investing term where you take money from one account and move it to another where it's just going to sit. You sweep it in there, and as long as you can move, you are aware enough to move it out before tax time, before the hacienda is going to debit it, then that's one method you could put in place. A gestor should be able to optimize your strategy for you on that one. The good ones will, but if not, you can always look at these shorter term sweeps to boost shorter term revenue, basically. Put your money to work for you. It's what corporate treasuries do, and effectively as an autonomo, you're a business yourself. So there's no reason why you shouldn't be doing some corporate finance activity like that.
I think maybe because interest rates have been so low for such a long time, we've all stopped really even thinking about them and wondering, it often seems that Spanish banks still give us a very poor deal on interest rates.
Yes.
We do have access to things like Wise and Revolut for better rates, but do you have any other recommendations for where people could do that saving of their course?
The issue is going into sort of macroeconomics and how the economy works in general, not just transactions between individuals. But the issue is that central banks, the banks of banks, they try to control the supply of money and inflation using interest rates. And the logic at the highest level is if the economy is a bit too hot, inflation is too high, they raise interest rates to get people to leave money in the bank and stop spending, and making it less interesting for people to borrow because it costs more in interest. And pretty much in the past 3-4 years in that cycle, we saw inflation hit levels that, well, I don't think any of us were either alive or we were adults to see that happening. And that led to the situation where we got kind of used to just depositing our money and getting 3.5-4% on the return. Well, when inflation, the issue with that is if as inflation goes down, you want to keep the economy going because you don't want to cause a recession. So central bankers will cut interest rates to keep activity humming. And they try to go for like a 2% inflation target. Just this week, the European Central Bank, they're having a meeting right now in Lisbon, in Sintra, right outside Lisbon. And more or less the discussions coming out of there is, well, what's the next step? Are they going to continue to cut rates? Seems like probably not, but it really depends on, well, effectively Germany is the benchmark here. But really the issue is as interest rates keep going down, well, that means savings accounts and deposits and everything linked to it goes down as well. So in terms of return, you're going to look at places like Wise, Revolut, other neobanks for like these higher interest deposits. You have higher interest, high yield savings accounts, which are actually money market mutual funds, where you're investing into the money markets where banks and financial institutions and companies lend to each other overnight. Those are the ones that were actually getting the higher return, and they still do. If you have a bit of a longer term goal and you can put that money away, there's websites like Raisin and Pick the Banks, where you can pick what's known as a term deposit account, where you can leave your money into a bank account for a set term. And as long as you don't touch it beforehand, you'll get a bit higher interest rates. CD accounts, if you're coming from the United States. I can share some links for those as well.
Great. Okay. We had a couple of questions in advance came in around pensions. This is thinking about the autonomous pensions for people who are probably, all things being equal, going to be staying here long term, retiring in Spain. People have been told by their bank or their savings institution, you can't touch that until you're 67 or wherever they move the goalposts to by then. But what happens after that? What are the choices? Because they're in some countries you can take out a lump sum, in others you would typically buy an annuity type product. What are the options typically here to generate an income from that fund one day?
Well, it will really depend on the fund and the plan itself. Some of them will shift automatically into a income, so an annuity style where it's paying you a monthly payment. Others, if it's a lump sum, well, you just have to take it as the lump sum. Generally, what you'd want to do is look at, in advance, they're going to be able to tell you what that monthly payment will look like. And you're going to want to start looking at your options to see if there's a better one out there. Generally, these are sold as life insurance products just because it can be efficient in the sense that you can leave the remaining balance or whatever the terms of the contract is to your heirs. Other things that you can do is you can take the information, the money in a lump sum payment and invest it yourself. Ideally, you want to shoot for around a 3 to 4% annual return. And the goal here is to not spend all the money down. And this is one of the big misconceptions is like, I got this big savings in retirement account. So for example, like I built my fourth pillar, I have 1.5 million euros because I've been quite prudent about it. But my concern is, well, I have this longevity risk, which means I'm going to outlive my retirement fund. And I'm going to spend the last years of my life eating beans and being miserable. Well, the trick is instead of having to spend that money down, is you're going to invest it into either an annuity, which is in a type of investment fund that will just generate annual income forever and pay you a big chunk of that, or you sort of do that yourself and you're investing it into different investment funds that are targeting around 4 or 5% annual return. what's interesting here is it's growing enough to generate income for you, but it's at a low enough return that it's fairly certain. And this is pretty much a way that you can create this additional income stream. So ideally what you're going to have, you'll have your state social security, and let's just assume we figure out how to keep those solvent. You're going to have maybe your second or third pillar pension because you took advantage of some credits. And then you've got your third pillar there, your fourth pillar, where it's some form of investment funds. Maybe you have a rental property somewhere, whatever it is. And that's really going to be your blend of your stream. And the idea, again, with your fourth pillar is you can be a little bit more ambitious and take a little bit more risk, knowing that the other pillars are going to be conservative for you.
Brilliant. Okay, well, I'm aware we're coming to the top of the hour, and we haven't had many questions asked live because I think a lot of this is really personal. I did just want to address, well, we've got you here, Elliott. We had a number of questions that came in advance, all pretty much along the same lines of what a sort of getting away with it mindset, but what does Spain know? Does Spain know about my crypto? Does Spain know about my Revolut assets that maybe haven't quite made it to the wealth declaration form over the years? And it's like, some of this fourth pillar stuff might be a bit edgy and a bit off the books. So
yes.
I don't know what you're comfortable saying about that.
Sure. First, if you can stop the recording. No. First, if anyone's interested, here's the guide. It also has the link to the promo on this session with us inside of it, as well as a landing page there. But yeah, that's there's a on the record answer and there's an off the record answer, and just in general, you should assume that they can. Technically, they have the right to know. You also look into the whole, however, it's a bit of a gray area because, again, this is your financial data is your personal data, first off, and they would probably want to have some sort of investigation or need to look into it. Now, the tax people could say, well, hey, we think there's something shady going on, and they can start asking you to produce that, and then they'll have those documents, and if you don't want to cooperate, they could probably get that information from the bank. Talk about foreign bank accounts. Generally, countries in the OECD countries, so the Organization for Economic Cooperation and Development, they are in this agreement called the Common Reporting Standard, which requires all the institutions to report back to the country of origin of their foreign customers. In other words, let's say if you have a bank account in France, but you live in Spain, that French bank has to send that information to the Spanish, the Bank of Spain, who will distribute that information accordingly. The exception says the United States doesn't participate in the system. They participate in something else. That's another story for another day. I saw a question about an American, and they're happy to answer questions about that. Canada's there's the United States and everyone else. In theory, they should be reporting this information, and you should be reporting it as well. If you think about how many bank accounts are out there and how many billions of transactions there are a day and how limited the resources are in the government, and especially since they probably haven't implemented AI or anything, some very smart way to go through this data, if there's the risk that they don't find out. By the book, you should probably declare this. Again,
fair enough.
Yeah, that's
Yeah, I think that's the question. I think the final question that we've just had in the comment from Ash isn't about anything dodgy by the looks of things, just to be very clear, because it was on the screen while you were talking about hiding things. But what happens to those funds, if we can look at that quickly?
Yeah, so that's a really fascinating one. And what Ash is asking about are these retirement investment accounts. And in many countries, we don't have this here in Spain, but in many countries, they will encourage people to invest in their retirement through special types of retirement accounts. In the UK, they have these things called ISA, individual savings accounts. The US, you have these things called Roth IRAs or just IRAs, individual retirement accounts. All of those are meant to help you invest and save your money for retirement, and there's some tax incentives behind it. Generally, if you have these in other countries, it will depend on how Spain sees those in relation to the tax treaty between them. And this is where it gets really complicated. ISA accounts or Roth IRAs in the US, Spain doesn't recognize as retirement accounts, which means that they don't recognize the tax-free benefits that they have in the United States and the UK as being valid here. So you have to pay tax on the activity inside it in Spain, even if in the country where it's based, you wouldn't have to. 401ks are slightly different, as those are probably about the closest thing to employer-backed pensions. And what's really been interesting in the discussion on the tax side, to be clear, I'm not an accountant, I'm not a tax expert, but just because of what I do, I have to understand taxes. On the 401k side, the general consensus is that, well, this is considered a retirement account in the sense that, an employment-based retirement or pension account. So we generally wouldn't tax the activity inside of it. But when you start receiving money from it, that will go towards your taxable income. There's really two sides to this question is, A, while it's growing before you retire, does Spain see this as taxable activity inside that account, or is it a sheltered pension account? And then B, what is the income coming out of it? And accounts like an ISA in the UK or a Roth IRA, you don't pay tax on the distributions from it, but in Spain you would as well. So let's say you retire, you worked all your life in the United States and then you move here to retire and you have a Roth IRA, well, you're gonna have to pay tax to Spain on that Roth IRA's distributions. For the Canadian one, I have that written down somewhere. I can't answer that off the top of my head, but that's the general idea. It gets really complicated, and that's actually one of the issues that we saw when we started Abroaden was that you could get into some of these tax advantage savings and investment accounts in one country, but they become a headache when you move to another one, because all of a sudden whatever strategy you've built inside of it can create tax issues. And again, like that's where we saw the need with Abroaden, was to help give the information and the resources to help you understand this so you can make these decisions and bridge that gap between there. And we have a bunch of tools on our platform to give you the support you need to do so.
Brilliant. Because this is complicated, right? I mean,
Yes.
I've learned such a lot just from this webinar, Elliott. So I'm really grateful to you for coming and sharing your time, your expertise, and your wisdom with our audience here.
My
but
pleasure.
for every question that gets asked and answered, it's kind of triggering off a dozen more. And I would really, really suggest that you check out this offer on the screen to get access to Elliott's brain and resources on a more individual basis, and access to more tools and learning. Definitely get the free ebook, because
Yes.
that's a no-brainer. It's going to be like detailed notes on everything we've covered today.
Excellent. I see Carla, she's having an issue with the QR code. Let me just drop the link to the landing page real quick there, if that's okay.
Brilliant. Yeah, if you can drop that in a comment.
Give me just a second to pull that out.
Great. And
yeah, this is fun. I want to do another session sometime. I'm more than happy to do so. And
fantastic. And if you can share with us your webinar you've got coming up about the currency arbitrage, share that, and we'll put it out on our socials, because
Perfect.
I think that'd be really valuable for people who are working internationally. For the freelancers working in euros, that's great. You don't have to worry about any of this stuff, but it's volatile times that we're living in, and it's knowledge is power.
Not good. Yeah, it's exactly that. Spoiler alert, like we're getting back to where the historical Euro USD exchange rate was, and we had some really good times for those of us making dollars, but
those days may be past, but who knows what's going to happen in the future. And yeah, lots to think about. So, okay, that's great. Elliott's dropped the link into the comments on the webinar platform. So for anybody who came in late, I saw the number of live viewers go up and down a bit. It's hot, we're all busy. For freelancers, we're doing a million different things. So don't worry, you can watch it back on the live stream. And if you register for the webinar itself, you're going to get an email with a link to watch the whole thing from the beginning. Even if you joined us live, you might want to watch it again and go through and pick out the bits that you need. So I'm going to be respectful of everybody's time now, because we're well over our intended hour. There was so much to get into here, but I just want to take a few more seconds to say thank you. Thank you very much for everybody who joined us, for everybody watching the recording and being part of the Remote Work Europe community. And thank you very much, Elliott, for sharing your insight and wisdom with us today.
Oh, my pleasure. Thank you for having me. Everyone, I wish you a wonderful day, and try to stay cool. And you know what? It's July. If you're going to splurge a little bit on ice cream, go ahead and do it.
Fair enough. Expensive Barcelona Italian ice cream. Go for it.
That's right. I got a place though. So financial well-being is always about finding the deals on the ice cream too.
Excellent. Maybe we should drop in a comment about that. Enjoy, everybody. Have a great afternoon.
That's right. If you sign up, I'll email you my ice cream list. Have a wonderful one, everyone.